Once has grabbed 3 times holiday best friends award, sir, and at a national level. And students level also, we got the 3 times SIRC level best friends students award. And our members are also well versed in knowledge. Okay. Happy to be here. Thank you.
Thanks a lot, sir. Thanks. Keep on open.
Sure, Laura, sir. Yes, sir. Questions will be asked at the end of the session.
I'm okay with it anyways.
Sir, if you okay with anyway, means it means the session will not continue. Next to continue the session. To say at the end of the session.
No issues. No issues. Yeah. Yeah. Sure. Sure.
Questions will be asked. Session will be going responsible.
Good afternoon to all. Very happy to be here, standing in front of you people. As Mr. Chairman said, it very one of the major things which makes me feel happy is I have my student Pratyush. So he did articles with me, and he's one of the youngest chartered accountants from my office. Of course, son of Mr. Rao.
Yeah.
So through that, this place is something which is very close to me. Pratyush has been with me for 2 years. Out of 3 years in our office, we have a concept where we make sure article gets 1 year of exposure in 3 divisions. And unfortunately, he was part of COVID time. So he got an opportunity to work more in audit. And it is something which we like. Our article, this time we had 7 articles. This time we had 7 articles. We have around 78 articles working with us. And that gives me a lot of happiness for making our students grow in their life and also achieve something big. And it matters when these kids take a profession than getting into industry. So that way, Pratyush is very close to me. And of course, because of him, this place is very close to me. The moment I got a call from sir, immediately I accepted for two reasons. One, of course, it was from Mohan sir, and again Pratyush is there, and that was something which I should thank the committee for letting me come here and giving me an option to talk in front of you. With this, so today's session, I'll be talking on certain fundamental things on accounting standards, ICDS, and I will also try to inculcate certain fundamental actions as an auditor we have to practice. In the just 5 minutes back, chairman was talking about using technology, and using technology is something which is the only solution for auditors. Believe me or not, there are various reports which my office generates, and in those reports, we use a lot of artificial intelligence. Today, the kind of internal audit reports which we generate, we make something called a heat map. We draft something called a risk control matrix. We make something called flow charts. Most of these are prepared using technology, and these artificial intelligence, especially on ChatGPT, what it helps is in internal audit, what is important is how we put across our thought process. And ChatGPT is something which helps us a lot. Many people feel ChatGPT may be a competitor for human beings, but we feel this is a biggest advantage for us. We use it in a very, if at all we know how to use technology, that is going to be a game changer. As we are talking, I'm working with one of the clients for doing a transition from one ERP to the other ERP. And this is basically has to be integrated with US GAAP. The kind of data what I get from this artificial intelligence is so immense. Using those data, we are able to draft our checklist. We are able to make a document called RACI document. And using that, the entire project mapping is happening. Otherwise, we had to spend 4 5 days on developing a project plan. Nowadays, it is just a matter of 1 hour or 2 hours max, and we get those. In the same fashion, when we do audits, one of the fundamental things which we need to consider is sampling. For sampling, we use a tool, and that safeguards on multiple sides. One, there is a proper trail which tells what kind of samples we have verified. Second, these technologies have come up with various statistical tools. So I don't have to sit down, draw a macro or draw a Excel formula to identify samples. My tool does this, and that will get documented in our workflow. So like this, lot of tools are available. I request each one of you to go and check what kind of tools. Our own institute has provided quite a few tools, and the tools are given at a discounted rate for professionals. It is important for us to use those, and these tools also helps on various stuff. For example, you might have seen couple of orders has been passed by NAFRA, and if you go around those orders, the fundamental thing what they are questioning is how strong your documentation was, how equipped you are on auditing standards. We all talk accounting standards. We all feel proud speak knowing accounting standards. But unfortunately, what is important is auditing standards. The standards on audit is something which we should give more importance. Accounting standards are responsibilities of companies. As auditors, for us, it is required to comply with standards on audit. And if we comply with standards on audits, doing errors are very, very limited. We cannot go through bad time, and our procedures will be more simplified and more standardized. And that makes sure such kind of orders will not come against us. If you see last three orders, there are 3 or 4 items which NFRI is telling. Documentation done after closure of audit. Documentation does not have conclusion. There is working, but there is no conclusion in the working paper. There are audit reports with a qualification, but that qualification does not define what is the reason for qualification. Just a standalone disclaimer is not sufficient. You should explain why you have given a disclaimer. That is one. And fourth one, something which is very important, is the materiality or the audit planning, which is the fundamental for any audit, those not being properly identified. So if we are able to comply with standards on audit, these things will be taken care, and the stakeholders will be taken care, and we don't have to worry about these questions or investigation from any authorities. So with that, I would like to start the session. The session is on accounting standards. Why should accounting standards be given importance? What makes accounting standards important rules or regulation which drives the accounts? If given an option, each of us would like to perform on our own. Each of us would like to behave on our own unless there is a uniformity. Only when there is uniformity, things can be compared. In a fast changing environment, if someone has to look at a financial statement, and if they have to decide on the financial statement, there has to be a uniformity in the financial statement as to how a revenue is identified, how balance sheet assets are being disclosed or computed, how liabilities are created in the books. And that is where accounting standards plays an important role. Accounting standards bring that uniformity in the financial statements, where any schedule 3 or any accounts which is prepared by the entity can be compared. Today we have guidance note on accounts for non-corporate entities also, like how we have schedule 3, we have guidance note from the institute on non-corporate entities. There is a guidance note on LLPs, and there is also a guidance note for non-profit organizations. So these are all the standards which brings a uniformity amongst each financial statements. Second, why again accounting standards are important is, with the globalization, with lot of things happening, you all would have seen during COVID, there was a very huge investment which happened on Geo platform. Companies across the globe, well, you take Facebook or whoever it is, they invested multi-billion dollars on that. And all those things happened without a single person traveling from the United States to the Bombay. It all happened sitting wherever they were. And what was the reason that could happen and such that much of amount could come to India? Only because today Indian accounting standards are on par with international financial reporting standards. The India's what companies prepare. They are so much compliant with the IFRS. So people who are sitting across wherever they sit, if someone may be sitting in San Jose and someone may be sitting in London, they can read our books. They can confirm that financial statements are true and fair. These are the balance sheet assets and these are the liabilities in the balance sheet. Thanks to accounting standards, thanks to India's, majority of the mergers are happening without much challenges. People may not understand the language, whatever is spoken, but they understand the accounting terminologies. Across Europe, IFRS is applicable now. India has been converged into IFRS through India's. Australia Pacific is also on IFRS. So today, the same language is being used across all the countries. And that happened because of uniformity in the accounting standards. Second most important thing, what kind of presentations we make, what kind of disclosures we make in the financial, which matters. There are a big lot of disclosures which are coming. The recent one being ESG and all, which are going to be a game changer. What happens there is environmental, social, and governance, ESG, which you keep on hearing in future. Today, it is mandatory in the United States and couple of Europe countries and recommendatory in India. It's not very far that they will also become mandatory because that is the future. You will be seeing all these fossil fuel getting converted into electric energy and various importance have been given for the kind of clean energy what company works on. So ESG speaks about that, and the professionals who participate and who know ESG will have bigger advantage compared with others. The third most important thing when it comes to accounting standards, it is the responsibility of management to make sure they have chosen proper accounting policies and such accounting policies have been properly deployed. Finally, a good hold on accounting standards makes it a easier step for professional firms to get through the peer review evaluation. Even in peer review evaluation, importance will be given for standards on audit and accounting standards. And if our accounting work papers are compliant with this, it gives a better weightage. Few of the ICDS which has been updated or which has been enacted, there are around 10 income tax computation and disclosure standards which has been implemented. Accounting policies, ICDS 1, which is similar to AS 1. Valuation of inventories, ICDS 2, which is similar to AS 2. Construction contracts, ICDS 3, which is equivalent to AS 7. Revenue recognition, tangible fixed assets is ICDS 5, which is equivalent of AS 10. Effects of changes in foreign exchange rates, which is nothing but AS 11. Accounting for government grants, AS 12. Securities, AS 13. Borrowing costs and provisions. 10 ICDS has been prescribed by the authorities. The term ICDS is income tax computation and disclosure standards. Accounting standards are about accounting, and ICDS are about how should computation be done. So why ICDS was required? Very simple example. When it comes to foreign exchange fluctuation, you will see a lot of case laws which define and which explain how should you claim foreign exchange loss. There are hundreds of case laws which says an unrealized loss should not be allowed as a deduction, and equal number of case laws you may find which allows even those. So there was a requirement from income tax side to have uniformity. And that is where income tax authority came up with ICDS. With ICDS coming, majority of the doubts, majority of the debate, which used to be there around in this computation, in this computation thing, has been resolved. Today, whatever is told in ICDS will override any of the earlier case laws, any of the earlier hiccups which were existing. ICDS is nothing to do with accounts. ICDS is more on the computation and disclosure. All that Excel sheet computation, what we do, should be driven using ICDS. So on background, how did the ICDS come up? Why the powers which were given in section 145 subsection 2 of the Act, central government has issued ICDS. And as I mentioned, there are 10 ICDS which are issued till date. ICDS applies for all the entities who follow mercantile system of accounting. ICDS is applicable when you compute income from profession or business and income from other sources. ICDS is generally applicable for individuals and HUF when they are liable for tax audit. Imagine a scenario where an assessee is maintaining books of account under cash system. ICDS will not be applicable for them. The moment we say the system of accounting used, methodology used is cash, in your ITR, that particular clause on ICDS gets hidden. So you don't have to worry much about when they are maintaining cash system of accounting. Is ICDS applicable for entities liable for Ind AS? ICDS is applicable for all the entities, whether they are following AS or Ind AS or anything else. If at all they have to file their tax returns with the authorities, they should follow ICDS. Just one concept which I would like to take up here: change in method of accounting versus change in accounting policy. Change in accounting policy is something where we talk about moving from a system of accounting, one accounting policy to the other accounting policy, which is more of prospective adjustments. We do adjust for retrospective things, but accounting method of accounting is about whether I am following cash system or mercantile system. It is allowed to move from one methodology to the other methodology, but it should be consistent. I cannot keep on churning around between cash and mercantile. Once chosen, has to be continued for a long. Certain ICDS provisions are inconsistent with judicial precedents. I would like to take up certain FAQs which are there. Wherever ICDS is not consistent with judicial precedents, what will override or what will continue to be applicable is, of course, ICDS. Even though judicial precedents are against the ICDS, ICDS is something which has been analyzed and implemented based on the past case laws. So ICDS will override all the case laws. If there is a conflict between ICDS and other provisions of income tax rules, what will sustain? Obviously, rules will sustain. Rules will have a better weightage than ICDS. ICDS versus circulars. We all know circulars are basically guidelines given by the regulator, CBDT, to the employees, to the income tax officials. It is not binding on assessing. So if there is any complication or any contraction between ICDS and circulars, obviously ICDS will override. Whether ICDS apply for an entity which follows MAT or AMT, yes, ICDS applies for the basic things of how you compute the revenue. After revenue, if you all know, 115JB has its own additions and deletions. You will follow those and no need to update any of the other complaints as per ICDS. For computing revenue, ICDS will be applicable. Interplay, why ICDS and where and all it comes in our work. One, in tax audit report, there is a clause where tax auditor has to comment on the complaints with ICDS. Subsequently, there is also disclosure. So clause 14 talks about ICDS. It says method of valuation of closing stock employed in the previous year, followed by next question, details of deviation, if any, from the method of valuation prescribed under section 145 and the effect thereof. So here in this particular tab, we give in detail. There are 10 accounting ICDS. Each of the ICDS, what is the impact? Of course, ICDS 1 is more on the policy. In the balance, what is the impact? Whether because of this ICDS, is there an increment in the profit or reduction in the profit? Maybe few examples. Say an entity had to capitalize the borrowing cost, but it had not followed the ICDS on borrowing cost. They have debited it to P&L. So as an auditor, you will confirm, you will review the books of account. You come to a conclusion that interest should have been capitalized. At that point in time, if when you disallow that, it will lead to an increase in the profit. That much of amount will come in column 3, and in column 4 you may allow the depreciation on such interest. So we will do 2 adjustments because of borrowing cost, and that comes here. The moment that amount comes here, automatically gives a kind of indication for the income tax returns, and in income tax return, this much amount should be disallowed, and you will end up, the assessee ends up paying taxes. The next clause where ICDS is being spoken is about the disclosures. For each of the ICDS, except for 2 ICDS, the disclosures are applicable. The 2 are basically foreign exchange fluctuation and securities. Other than that, as a tax auditor, we need to comment whether their disclosures have been appropriate or not. I'll be talking about disclosures detailed in subsequent slides. And this is what the ICDS which appears in IT return. Under IT return, as I mentioned in my earlier slide, whatever the auditor comments and discloses in 3CD, a photocopy of that or a replica of that will come and sit in IT returns. If there are any differences, there are chances that assessee will get a notice from the department. Today, as we all know, tax audit report and ITRs are so much connected. Any error in 3CD or an ITR which gets identified, and the notice may get issued against that. Couple of times I have also seen few people commenting on 3CD for clauses like clause 18 is one of the famous clauses which is on depreciation. Few people have a habit of updating the difference in depreciation. We all know when we compute income tax, we may disallow depreciation as per the books. If at all the assessee has a policy which is different from income tax rules, we disallow as per books and we allow as per Income Tax Act. Few people update this in the tax audit report, but as per the guidance given, it need not to be updated. This is not a difference in ICDS. That is, ICDS speaks about what components to be considered in fixed assets, what disclosure has to happen in fixed assets. Depreciation rates are not defined in ICDS. It is still in the schedule 1 of the rules. So we still follow that. Section 32 is one section which allows depreciation. So even if that is not disclosed here, that is fine. But nothing stops from disclosing. There are various professionals who make a disclosure over there. Coming to ICDS 1, accounting policies. By name itself, there is a contradiction. We call ICDS, Income Computation Disclosure Standard, but we also say accounting policy. Why should there be accounting policy in ICDS? The background or the thought process is very simple and pretty strong also. For anybody to apply computation, for an assessing officer to confirm whether the income computed is right or wrong, he should know what are all the policies the assessee has followed. Only when we know what policies the assessee has followed, we will be able to confirm whether the treatment what they have given in the books are right or wrong, and that made the department or the regulator to come up with ICDS 1. ICDS 1, the scope wise, it talks more on the significant accounting policies. It gives importance for only significant accounting policies. Significant policies are those which affects the decision of stakeholders. If an error in this accounting policy may impact the decision which a stakeholder can take, and those policies needs to be disclosed. ICDS 1 should be regarded merely as a disclosure standard and not as a computation standard. The term accounting policies should be read as Computation policies. So for me to do a computation, what policies am I following is there in ICDS 1. Fundamental accounting assumptions, as we all know, one is going concern, second is consistency, and third is accrual. Why going concern is important? The financial statements are deemed to be prepared on a going concern concept. No assessee thinks that I need to close my operation is the thought process. ICDS is silent. If something is not undergoing concern, what adjustments needs to be done in computation, nothing is mentioned in ICDS. Under AS1, it tells if the assessee is not, rather if the entity is not following going concern, they need to make the financial statements which are more which gives the idea of what could be the amount which they get if they liquidate. Generally, if I have to sell my assets and liabilities, what amount I get, that gets disclosed the moment going concern is not there. That what is the impact of ICDS, or what's the impact of computation, which not defined anywhere in the standard. Second, consistency. Once you choose one particular policy, it is mandatory, it is forced to consistently follow these standards. We cannot keep changing it. Changing of policy is allowed, provided there is a reason which is very much strong and material. Because of a change in an accounting policy, where amendment in accounting policy, I can follow that. Because the change in the methodology in which I used to work, I may change the accounting policies. When there is a change in accounting policy, I need to show the impact of changes on the books of account. If the impact is not there in the current year, if the impact is on the future years, you have to disclose that amount also. Accrual, we all know section 5 itself tells the financials, or rather the computation will be on accrual basis. Here, the concern or the objective is whether the money is received or not, income will be taxed. Income needs to be accounted. Whether payment is made or not, deduction will be allowed, unless those cases which falls under section 43B. Accounting policy refers to specific principles and methods applying those principles adopted by a person. Considerations which has to be there before we select an accounting policy. First, we have to give the importance for substance and not for the form. Second, in ICDS, the concept of prudence, which is not there, like I cannot, even though there is a possible losses under income taxes, it will not get allowed. That will also be considered. Few of the examples, many of the cases, when we make provision for bad debts, we have to disallow in the computation. Provision for warranty generally gets disallowed unless it is based on a scientific backup. Provision for slow moving inventory gets disallowed. Provision for gratuity gets disallowed. So all those provisions which will be allowed only on actual basis and gets disallowed otherwise. One of the FAQs, ICDS 1 provides that an accounting policy shall not be changed without reasonable cause. The term reasonable cause is not defined. So what exactly reasonable cause is? Judgment plays an important role. Say, for example, there is there used to be an entity which used to compute inventory on a FIFO basis, and they come to a new methodology where the inventories are running at a very high pace, volume is increased, and they need a proper control on the budget and the actuals. They decide, I would like to go into standard costing. This is a reasonable cost. They are not doing just to avoid some error. They are not doing because their system is not able to give proper things. There is a proper explanation given, and they are moving from a system which is not that advanced to a system which is more advanced. Getting into standard costing is a better picture, and hence that is a substantial reason. If someone wants to change just because in one of the years there was a mistake, to avoid that, if they are changing, that is not a reasonable cause. Disclosure of accounting policies. All significant accounting policy needs to be disclosed. A change in accounting policy needs to be disclosed by the assessee. This is all about ICDS 1. Couple of practical issues whenever we do audits. The whole ICDS or the whole computation goes well if each of us have the good hold on the knowledge of business. What kind of activities are done? What are all the possible regulations which are applicable? What are all the systems which they are using? How strong their internal controls is so that a balance sheet item has not come onto the P&L item? What kind of benefits are they eligible for, and are they accounting for those? Are there any possible additional duties which they had to pay, whether they have paid it or not? So end of the day, a good hold on the business and the knowledge of operations is vital for any chart accountant to do the audit and to complete the computation. Statutes applicable, which I explained in the knowledge itself. Employee benefits. Many of the times I see people doing certain errors when they compute employee benefits. There is a standard which speaks about employee benefits, which is AS 15, which talks about gratuity. Many of them I have seen in my career where they talk, I don't have to pay gratuity until someone completes 5 years. That's a mistake. It is not that someone has to complete 5 years. The day he joins, I need to start accruing gratuity. Payment may happen once he completes 4 years and 9 months. So this kind of knowledge, hold on the standard, helps us to give a proper report. Investments, the kind of valuation which happens on investment, the kind of impairment which happens on the investment, various standards speaks about those. Hold on that is also very much essential. Insights on Ind AS. Couple of accounting standards got amended. For example, AS 6 got deleted and became part of AS 10. Couple of amendments also happened in AS 10. Few amendments happened in AS 15. So all these amendments are happening because the accounting standards over a period get transitioned to Ind AS. Ind AS is our standards, which is on par with IFRS. It's not too far that majority of our accounting standards gets into Ind AS thing. It's important for all of us to know what exactly is told in Ind AS. The fundamental feature in Ind AS is fair value of accounting. To give a simple example, how Ind AS helps financial statements to be read properly vis-a-vis AS. Let us take an example. All of us know we have a very big public company called Life Insurance Corporation of India. And Life Insurance Corporation of India, if you know, is the biggest real estate owner in India. Wherever they go, they buy land and they build their building. One. And second, the kind of funds which they have invested on various companies. If you take Reliance, if you take Infosys, or any name for that matter, one of the biggest shareholders will obviously be LIC. And if you see their books, if at all they had to update their books until last couple of years, they were following AS. Now they are doing Ind AS. Those land which was purchased in 1960s, 1970s, they used to show at that particular rate. But today, the value of that land would have increased by almost 50 to 100 times. The balance sheet does not give that picture. On one hand, you will see a huge liability. On the other hand, the assets are underbooked. Similar way, like our AS 13, in AS 13, it says we have to show investments at cost. If you are not following fair value through PL or fair value through OCA, which is the scenario in Ind AS, your investments does not show true picture. And this one small example is enough for us to know the impact of Ind AS on financial statements. And majority of the times, companies try to avoid or take exemptions in Ind AS. If you ask me, it is important that you take up all the possible disclosures and impact of Ind AS. It adds value to the company, and it also adds value. It makes stakeholders, it strengthens stakeholders to take decision on that. So with this, I request each one of you to spend time on Ind AS, understand what they are, and get to understand how industry is changing. ICDS, the next one is ICDS2, valuation of inventories, which gives information about how should inventory be treated in the books of account and what impact it may have on computation. Measurement of inventory, we all know AS2 says inventories are computed either at cost or net realizable value, whichever is lower. Net realizable value is basically the price at which I can sell in the market after reducing the cost to sell. Why NRV will come into picture? Say, for example, during COVID, lot of people had this challenge. Their products became so difficult to be sold for obvious reasons, and they had to bring their inventory into NRV. And NRV would have been the scrap value because they are all generally not saleable. Yes. And this has to be done on a regular basis. On every reporting, you need to review what is the NRV. The best way to review NRV is check what was the recent sale price, then compute what is the cost which you need to incur to sell those. The net of those two will give you NRV. And if that NRV is less than the cost, the differential, whatever is the loss, debit to P&L, that is as per the accounting standard 2. There used to be a lot of challenges, like how our in all other cases we say an expenditure can be allowed as a deduction if it is actually incurred. In AS2, when they say the inventory has to be computed at cost and narrow, whichever is lower, it was not incurred. It was still lying in my books, and there was a chance that people used to argue there is a chance that it may even go high. So that is where ICDS 2 comes into picture, and they clarified if you do this and if you debit to P&L, you are still eligible to claim a deduction. There is a similar concept, cost or NRV. There is under accounting standard 29, and of course ICDS 10, which speaks about provision. There are few entities which make something called provision for slow moving inventory. They make buckets of each inventory, different types of inventories. They say few of the inventories are there in my godown for very long, and the capabilities or the because of wear and tear, because of certain changes in the technology, the capability for me to sell that would have been diluted, and the value of that, the possible probable selling price would have got reduced. Here it is only an assumption. Based on that, they create an ad hoc provision. That's and again that they hit it to inventory. If you go and see inventory, they in our books we would have shown closing inventory, raw materials, finished goods, WIP. From there, they reduce as provision for inventory. That goes under AS 29 and ICDS 10 and not under ICDS 2. That should not be allowed as a deduction. What is part of inventory? One, purchase cost, service cost, cost of conversion, and overheads, if any. Purchase costs are generally the price which we incur for buying the inventory. And we also spend some money to bring that inventory to its present location. That may be freight, that may be duties and taxes, and etc. That needs to be added. If at all we are able to get some sort of trade benefits or rebates today through various government policies, one of the biggest policies is production linked incentive. Then there is something called mover. Then there are various customs related benefits which are available. Through that, if at all there is any benefit on the inventory which I am buying, that benefit needs to be reduced from my cost of purchase. PLI is the best example for this. Service cost includes labor and other personnel cost, which is directly involved. If I am converting steel into a steel bar, what I take is steel wire, that is my raw material. I use power to convert, to make it into a product which in the shape I need. I spend money on employees who run the plant. I spend money on plant. I would have purchased a plant which has a life of X number of years, and that amount, gets amortized as depreciation. That also I will add into cost of my inventory. Overheads are generally something which is vital in the conversion, but excludes something like sales and marketing, rent, and similar ones. So overheads which are incurred for converting raw materials into finished goods, we should add, which again, as I explained, it could be something related to employee welfare. It could be something related to even sometimes what happens if the products takes longer gestation, even rent gets added over there. Interest can be added if it is a longer gestation. So those things gets added. Work in progress for service provider. When ICDS 2 came into picture, there was a lot of hangama telling ICDS is applicable for service provider also. Service providers like us who maintain, if at all we are maintaining books under accrual, for the service which we have completed, but we have not billed, that much needs to be shown as WIP. That was a bigger challenge. But later, they came up with the explanation and they removed that. With the ICDS 2, which actually came, that particular clause is not there for service providers as such. But it has come with little different thing. It comes in the revenue recognition, which I'll explain. Impact of 145A on ICDS. As such, 145A speaks about how should we treat the goods and service tax or related taxes for the purchases and sales which we make. 145A says include the taxes. But 145A also is very clear. It has a neutral effect. I add taxes on my opening on my inventory. I add taxes on purchases. I reduce and also I add taxes on sales. If you take the net amount, it is always equal. The impact will be nil, and 145 hence does not have any impact on ICDS. Why should there be ICDS 2? Inventory, for wherever inventory is, generally it will be in manufacturing entities, and inventory is one of the biggest assets. Like how in service industry like software, employee resource is the biggest resource. In manufacturing, raw materials or rather inventories will be a biggest things. That is why there is the need for ICDS. And inventory is one such element which gets carried forward to subsequent years. Not all the expenses gets carried forward. It's only inventory which gets carried forward. So there should not be any errors in the computation. How should we allocate fixed overheads and variable overheads? Fixed overheads are generally allocated on the normal capacity. Variable overheads are allocated over the actual production. Packing materials can be broken into primary and secondary. Primary packing materials cost gets added to the inventory. Secondary are generally considered as marketing cost, which goes to P&L. Selling and distribution costs are not incurred for bringing the inventory to its present condition. It will not go to inventory. Inventory write down and its reversal. It's again a concept of accounting. A write down is like whatever I just explained, a provision which they create for reducing the value of inventory. The impact will directly come on the P&L, but it gets disallowed while computing. Whether the following cost should be considered while determining the NRV of the inventories. Cost of completion of work in progress. Yes, it has to be considered. Trade discounts expected to be allowed on sales. There is an inventory in my hand and I know that I'm going to give a trade discount. Then I should consider it as a reduction while computing NRV. Cash discounts are generally not considered while computing the NRV. Purchase on a deferred settlement scheme. There are certain possibilities that if I go to vendor and if I tell him that I will pay you over a period of time, there is a possibility he will add interest. Should that interest be added to inventory as per ICDS or AS or Ind AS? In Ind AS, there is a separate concept. Generally, in ICDS and AS, we should not add it. Provision for interest. Usage of ERP is something which we generally face challenges. The way ERP works, if you go and see SAP, you will not get a detailed report of inventory movements. You will get one purchase register, you will get one sales register, you will get one inventory register. So a good hold on SAP, how it goes, how a standard costing is done, how inventory gets moved, that is very essential. For example, how inventory gets recorded in SAP is, if I have sold 100 kgs of one material, one item, only when I sell, an entry on COGS will get passed. So there would have been one formula or one definition which should have been given. For me to make 100 kg of my final product, I need 120 kgs of raw materials, 10 kgs of consumables, 20 kgs of chemicals. So that formula would have been made. And the moment I pass a sale entry, a consumption entry which includes all these three transactions will get accounted. So when consumption of these three items gets accounted, closing inventory gets updated. So that is where it is important for us to understand how ERP works. Today, majority of the people are moving from Tally to Zoho Books. Zoho Books has not completely come up with inventory module. They are in the process of updating their inventory module. And more or less, Zoho Books will become a next big thing after Tally. So having a good hold on Zoho and their inventory module is very much essential. Otherwise, if you see, one of the basic ratio in manufacturing company is GP ratio. You will not be able to have a control on GP ratio unless you know how inventory module works. Again, inventory reconciliation between books and whatever is filed with banks, something which we need to be very conscious on. Inventory as per books and GST records, how much purchased, how much sold, how much is pending, that should match with the GST records. Inventory quantity details for 3CD. In form number 3CD, we talk about certain major inventories and their quantifications. So there also it is connected. With if any of the mistakes happen in these three items, we generally do due diligence on financial statements, and that is where we see lot of errors in quantitative details. And trust me, when we do due diligence, if there are concerns in inventory, majority of the times the entire deal doesn't move forward. It is a question on the internal controls of the entities. It is a question on the yield. Many times when we do in due diligence, we realize their yield ratio is negative. We come across their inventory showing negative balance. These are all the reasons are not having proper internal controls or not defining an input output ratio. And unfortunately, this will not come on the financial statements when they prepare. But knowing these standards and these ratios helps us to perform a better audit. Disclosures on ICDS 2. One, the accounting policy which the entity has adopted for measuring inventories and the cost formulae, whether it is FIFO or weighted average or standard cost. Where standard cost has been used, it is mandatory that you should disclose we have used standard cost. The moment there is standard cost, there could be something called under absorption and over absorption. That also plays an important role. The total carrying amount of inventory classification needs to be appropriately disclosed. Of course, it comes in the balance sheet. It has to be disclosed appropriately. Going to the third one, ICDS 3, the construction contracts. Construction contracts, again, real estate is dynamic industry. The way revenue works, you can see it like if all the industries work in one fashion on revenue, real estate works in a different way. If I'm a trader, it is very easy. I buy one product and I sell it to someone. It is a very simple one. If I'm a service provider, I consume certain products and I provide service. The service will be having a price for it. If I am a software developer, again, I will use employees and I provide software. But in real estate or in a works contract, what happens is the assessee will be constructing an immovable property, which generally takes a time which is considerably high. I may start in current year and I may complete it after 5 years or 6 years. In this whole process, I'll spend so much of money and I may not even be able to sell all the products within a short period, or it will take a longer period, or even after completion, I might not have sold majority of my products or rather goods. And that is where the challenge comes. How should we account revenue? How should we account cost? How should we show inventory? For that, we have AS7, accounting standard 7 in AS. We have Ind AS 115 in Ind AS, and we have a guidance note on real estate under AS. Exactly, it says is when the time taken is more than a normal period, a nominal period, which is generally assumed to be 12 months, then you apply percentage of completion. The entire construction contracts in general, as long as they are maintaining mercantile system of accounting, they follow percentage of completion. So what exactly percent of completion is? We know what is the cost of the project and we know at what rate we'll be able to sell it. Keeping that as the denominator, for every rupee I spend, I compute what is the percentage, and on that percentage, I compute revenue and I account revenue. One exception which is there in ICDS is, which is little different from guidance note on works contract. In guidance note on works contract, there are three conditions, but in ICDS it says if the contract is not achieved 25% of completion, then you can account revenue to the extent of cost. Wherein AS7 read with a guidance note, there I don't even recognize revenue up till I reach 20%. Here the word used is I will account cost. I'm not going to account any margin on that. And with this, couple of things which happens in real estate is there can be advance from customers and there can be progress billings. So what happens in construction contracts is, assuming an assessee is building 20 apartments, for 20 apartments there are 20 sale agreements. Out of that, 10 sale agreements would have been entered, and in the sale agreement they would have told at the time you sign the sale agreement you should pay 30% advance, and after that I will call for every payment. I may call 5% each on completing a particular milestone. So all these amounts are shown in my books as advance. Against advance, we'll have unbilled revenue. Against advance, there could be cost of construction. So that is something which is there specifically in construction contracts. Cost of construction in construction contract is basically the material, the labor. Finance cost is very important. Unlike other industry, in construction, generally for working capital, they borrow money. And using borrowed funds, they construct. And using customer funds, they construct. So you have a concept called RERA, which restricts you to use customer balances when you are in real estate projects. Borrowing costs, which is already defined very detailed in section 3613, that continues to be applicable and that continues to define what is that amount which is allowable as a deduction. Survey of work performed is another item which we see in construction contract. Even though the percent of completion may show 60%, when we do the evaluation of project, a technical certificate, if I go and take, that may be different from 60%. And that is something again unique in construction contracts. Your cost of construction versus the technical confirmation. If the technical confirmation is different from what you are showing in the books, then you may have to adjust in the books of account. Early stages of contracts, which I explained, changes in estimates. More than often in work construction contracts, the estimates gets changed. Even though I have been very strong, I have been maintaining my purchases very neatly, there may be chances, there are few things which is not in my control, which changes my estimates. Few of the examples: steel price. Steel price is something which keeps on fluctuating, and every change in steel price will affect my cost of construction. Last year, there were 3 times RBI changed the banking interest rate. It was increased by 50 BPS 3 times. So, which resulted in a huge increase in the cost of borrowing. Imagine someone was in 12% borrowing. With all these three changes, they would have gone to 14% or 15%. Again, that affects my construction. One war happened, and because of that, all of a sudden, steel price increased. All of a sudden, cement price increased. Sand became not available. So all these things, the whole factor here is real estate or a works contract is so much dependent on the external market, and these things affects my cost of construction. And maybe every quarter or so, sometimes the estimates change, or sometimes on a yearly basis, estimates change. From 21-22 to 22-23, you can see the cost of construction has increased at least by 25 to 35% in the industry as such. So, with this change in the cost of construction, with this change in the estimation, it has a direct impact on revenue. Revenue should also be changed. If revenue is cannot be changed, then I will have to accrue it as losses. As per AS7, I will accrue the losses in the books, but ICDS does not allow me to claim it as a deduction immediately. That's again, there is a difference between ICDS and AS. Whatever I accrue there, I will disallow here, but I will claim it when actually I incur loss. It becomes a temporary difference, which leads to taxes on income as per AS20. Retention of money is one more concept in real estate, or generally, as Pratish was explaining, it is in government companies. Wherever you are dealing with government companies, what they say is, I'll pay you 80%, 20% I'll pay you if everything works good for next 2 years. How should this be accounted? Should I recognize revenue only to the extent of 80%, or should I recognize 100% revenue? Going by AS9 read with ICDS 4 or Ind AS 115, the revenue has to be computed for entire 100%, whether I have received the money or not. The concept here is very simple. It is like my project is for 100 rupees, but 20 rupees he is holding as a deposit. It is as good as he had paid me 100 rupees, then I gave him back 20 rupees as a deposit. Like how generally it happens in any lease documentation. I give a deposit. Like this, a deposit is given. So revenue should be recognized. There are few errors which we generally see in the books of account. People show it as trade receivable. 20% they show it as trade receivable, and they show it as aging receivable for more than 180 days, receivable for more than 360 days, which is a mistake. It is not receivable. They are due to pay only after 2 years. If something is due for more than 2 years, until 2 years, even though if I'm showing it as a trade receivable, I should show it as trade receivable but not due. And these kind of errors affects your ratios, and this also affects your credit rating when you go for the banks. If you have to apply Ind AS, this also affects something called expected credit loss. Ind AS works on a concept called expected credit loss. If, as I mentioned, Ind AS is more on the fair value basis. A rupee one today is not same rupee one tomorrow. It loses its value. So imagine I'm showing 20% as trade receivable from last 1 year. As per the concept of expected credit loss, which is Ind AS 109, there it says you have to discount that trade receivable. The moment you discount, whatever was 20% may actually come down to 18%. So there are multiple impacts which happens because of these errors. Practical insights, change in estimate, which we just discussed. Accounting for GST is again a very big issue in construction contract. As I was explaining, in construction contract, I raise a demand note and my customer pays me money. Whenever he pays me money, I am obligated to remit GST. Whenever he pays me money, he is obligated to deduct taxes as per the applicable Chapter 17B requirement. But my computation of revenue is based on percentage of completion. He might have paid me 40% advance. I have completed only 20% work. So I recognize revenue only 20%. Balance 20%, I will show it as advance from customers. Now, from the income tax side, he would have deducted on 40%, he would have deducted taxes. So income tax fees, I should have accounted 40%. From GST side, you would have paid me 40%. GST would have been remitted on 40%. GST department will say, again, give the same number. Both of them talk to each other. Income tax will send me a notice. So that is where the issue or challenge comes. That is where ICDS helps me to disclose. Under ICDS, I will disclose what is the revenue I have computed and what is the advance I have received from my customer. If these numbers are proper, even though if you receive a notice, you can explain them and you can close the chart. Another other issue which may come in construction contract is repurchase of apartment. I would have sold an apartment as a immobile property, then I buy it back. When I buy it back, it becomes a traded item. The way I disclose inventory, which I am constructing, I will show it as finished goods. The one which I have purchased, I will show it as tradable item. That also needs to be properly taken up. JDA and GST. JDA is Joint Development Agreements. Joint Development Agreement is basically a scenario where landlord has land mass. He will allow a developer to come and develop the project. At the end of the project, either he will give me some apartments or he will pay me some money and the transaction closes. In JDA, there will be so much of complexities when, if at all, the developer is giving apartment back to JD1, I mean the landlord, there is a GST on that, which comes under reverse charge. If he is paying cash, there is a capital gain. And when should I pay the capital gain? When third one could be, he is not paying me cash, he is giving me an apartment. Again, there is a capital gain. I am giving land to him. Against land, I am getting apartment. It is a consideration which I am getting. That apartment again I sell. Again, there is tax on that. So on one property which I had, I will have two taxations. And how do you deal with those taxations? That is also which is very much important. And JD is something which is pretty much complex, but there is so much things to learn over there. And someone who has a control on JD will have good control on stamp duty. They will have good control on GST. They will have very good control on taxation. So learning JD is something which is very important. Next, percent of completion versus percent of trade receivable. Just now I explained 30% I would have raised invoice, 40% I would have received money. That reconciliation. Again, what happens in works contract? I would have sent a demand note for 40%. They would have paid me money only for 30%. Then 10% is trade receivable. One guy would have done like this. Another fellow would have done, I would have raised demand note for 40, he would have paid me 50%. Then 10% is advance from customers. Revenue will be only 20%. So all these things disclosing in financial is very much important. Disclosures. First, the amount of contract revenue which I have recognized during the period and methods which I have used to compute the percentage of completion. Scenarios where project is closed. If project is not closed, important thing is to show advances which I have received and retention money, if any, which is being collected. Difference between AS and ICDS. Retention money, basically does not, AS7 does not speak, whereas ICDS tells you should accrue it as income. A big issue will come. As per AS, I don't recognize it as revenue. But ICDS, I am forced to recognize it as revenue. Tomorrow, that money never comes to me. He goes away. Then what happens? Because in AS, I have never accounted as income, and there is no question of writing it off. Here in ICDS, I should make another adjustment telling it was recoverable. Now it is written off. So I will claim under section 37. Provision for future anticipated losses. ES7 read with the guidance note is I should accrue for losses if my project is going to be a long-term loss project. Whereas under ICDS, it doesn't allow it. It will allow only when you actually incur the losses or when you end up with the losses. Fourth one, revenue recognition. Like AS7 is for construction contract, AS9 is for services or goods under AS9, the accounting standard. In ICDS also, we have ICDS 3 and ICDS 4. ICDS 4 is pretty much simple, similar to what AS9 is. It talks around all the transactions which happens in the general course of business, purchase and sale of goods, purchase and sale of services, using assets for various reasons. It may be for interest, for rent, dividend, royalty, etc. One important item which needs to be considered in ICDS revenue recognition is there a transfer of risk and rewards? Unless there is a transfer of risk and rewards, there is no question of revenue recognition. Couple of examples which generally accounts may do some errors. We see lot of transaction where they say the way pricing would have been decided, or rather the payment milestone would have been decided. The day I enter an engagement letter, I need to be paid 10% amount. After completing 2 months, I will have to be paid 30%. After 5 months, X percentage. Like that, they will make a timeline. So it says when I sign an engagement letter, I should be eligible to raise 10% advance. And this 10% will be raised as an invoice. And that also gets accounted as revenue. That is a mistake. You cannot, because when you have done this, you have neither performed your obligation nor the risk and rewards have been transferred. You have to wait until that particular event happens. So whatever this 10% you have received should be shown as advance from customers. Again, there could be scenario. After some time, you have raised an amount, an invoice. You would have been, as per the engagement terms, you are eligible to raise 40% of the amount as invoice, but you might have completed 50%. Now the bigger challenge will come. 40% anyway, you know that you have completed, you have raised. Another 10%, you know that you have completed, the customer has not yet accepted it. Then that you can consider as revenue. There is no way you can consider as unbilled revenue. Maybe you will, as per accounting standard, will consider it as work in progress. That work in progress is not applicable in ICDS if it is service contract. If it is other than service contract, yes, we will consider it as work in progress or inventory. Export incentive and price escalations. Export incentive, we cannot recognize until that money comes and hits my bank account. It has to be on cash system. All while we speak about accrual, but there are few cases where we account it only on actual receipt basis. Similar fashion, price escalations, until there is an escalation and there is a confirmation, I don't account it as my revenue. In ICDS, for service contracts, it says you have to use percentage of completion. And exemption from percentage of completion is allowed only if the service contract, the timeline, the period of contract is less than 90 days. If it is less than 90 days, I can do a completed project or completed contract method. I know what is my contract value. I know what time I'm going to spend on that. Only on completion of the contract, I recognize it as revenue. Otherwise, it will still show as cost. Examples, there are multiple service providers maybe housekeeping people, or maybe security people, maybe software maintenance people, annual contractors. So these people, they have to recognize based on the percentage of completion. Interest, like KS, it is accrued on a time basis. Interest on a refund of taxes duty accrued when actually accounted when actually it is received. Royalties, it will go as per the agreement. Such concerns in revenue recognition, terms of payment versus recognition, I explained. Foreign exchange, it happens. Again, couple of things which we see. Assuming I am an exporter, I have raised an invoice on my foreign customer. I would have raised today when the price is 83.5 rupees per United States dollar. INR is 83.5 per United States dollar. If I have raised $100 invoice, then it will be 83,500. 8,350 rupees is my revenue. He pays me after 20 days. At that time, the value, the US dollar value is 85. What I do is 83.5 is what I have accounted as revenue, 85 is what I have recovered the money. So 1.5 rupees is my foreign exchange gain. Certain errors which can happen here is in a small change in this story, instead of I raising invoice at 83.5, he has paid me money in advance at 83.5 rupees today, and I complete my project 2 weeks later. At that point in time, the exchange rate is 85. Here also, I have seen many people applying the same logic, which is wrong. In this case, the advance money what I have received, that particular transaction becomes a non-monetary transaction. He has already paid me advance 83.5. His obligation is over. If I raise an invoice after 2 weeks, that is my headache, and he is not going to pay me 85 rupees. He will pay me whatever he has paid is paid, and that I need to account at 83.5 rupees only, even though exchange rate is 85. The same thing applies if I am a buyer. If I need to buy on a credit basis, it becomes a monetary transaction. I should account foreign exchange fluctuation. If I have paid an advance, it becomes a non-monetary transaction. Then I cannot make any foreign fluctuation adjustment. Cutoff verification is something which is important in revenue recognition. We should see, are the contracts completely done before 31st March, or is there anything which is done post 31st March? Those adjustments needs to be done. And cutoff verification is something which will be taken seriously both by NAFRA and by peer reviewer. Our work paper, in the process, we should see what has happened subsequent to 31st March. Take up 10 days, 15 days, or 20 days. Understand what transaction has happened, whether the transaction needs to be updated for 31st March. There could also be a scenario by 31st March, the transaction has happened, but the transaction was not a free on board thing. In the sense, for me, it is my responsibility to make sure the material reaches my customer's location. I would have raised an invoice, I would have transferred my goods from my gate, but it has not reached my customer's location. In that case, I cannot recognize it as revenue. I need to wait until it reaches my customer's location and he accepts it. Similar case, there may be, imagine a scenario where I am a dealer and my customers are in the United States. For that, I have kept my inventory and my customer is on a just in time basis. When I say just in time, what we mean is whenever he wants, he'll pick it from my location. For me, it is required to keep inventory at his mercy. If he is in the United States, I will end up taking a warehouse in the United States and I will keep my inventory in United States warehouse. I raise an invoice from India. I should do bill of entry, bill of lading. I will complete all my customs compliance and I will raise a commercial invoice. but I cannot recognize it as revenue because it has gone from my place in India to my place in the United States. If you see custom records, it will show as a sale, but actually it is not a sale. If you see RBI records, my time to give the money back starts ticking as per RBI regulation. If I have done an export sale, rather, if I have done a transaction in a foreign currency, it is my duty to get the foreign currency within 9 months. And the challenge also happens here if I'm sending these materials on the water, on the seas, it will take 3 months, 4 months to reach the location. Already 3 months is gone. Then it will go and sit in my warehouse. 2 months it will sit in my warehouse. Then my customer will pick. After that, the credit period will start. So you need to plan it in such a fashion. You are in compliance with RBI regulations. You are compliance with ICDS. You are compliance with AS9. And this is where knowledge of business and hold on statute matters a lot. And you can add value to your customers, your clients. Works contract, I explained. Cost incurred towards earning the project. There are, it happens generally in software companies. If I need to get a client or a new customer, I may have to spend a big amount on creating an API for him. Imagine he is using one system and my software should go and work on his system, but my software doesn't talk to his system unless I create an API. And that API I may buy from someone, which may cost me a bomb. So what they do under India's 115 is this is called as contract cost. These costs I will not debit into P&L. Instead, I will show it as a contract asset. In a simple term, it is prepaid expense. I will allocate it over the period of my revenue recognition. If my contract is for 3 years, this I allocate over 3 years. Another example, if you see real estate companies, they give commission to commission agents. You get me tenant, I will pay you X percentage commission. That also, whatever commission I pay to my commission agents, I'm allowed to allocate over the life tenure of my tenant. But that doesn't work in ICDS. We have to change that. The day I have incurred, I will claim the expenditure. Whereas in books, I will allocate over the period. Disclosures under revenue recognition, transaction involving sale of goods, total amount not recognized as revenue during the year. Morning Pratish was telling, for goods, we don't have to disclose anything if my sales is done. For service, I should disclose everything. For goods, I should disclose if I have not accounted revenue. And that is little interesting over there. Amount of revenue from service transaction recognized as revenue during the year, I should disclose. Method used to determine stage of completion, I should disclose. For service transaction which are in WIP, amount of cost incurred and recognized profits like our accounting standard 7, we should disclose those. Amount of advance received, we should disclose. And amount of retentions, if any, which needs to be disclosed. Again, it helps in reconciling the numbers. What is that advance which I have received, which I have not accounted it as revenue. ICDS 5 on tangible fixed assets, which is accounting standard 10 on accounting standard 10 on property, plant and equipment. Ind AS 16, again property, plant and equipment. IAS 16, International Accounting Standards on property, plant and equipment. All the four are, they talk to each other rather. The way IAS 16 and Ind AS 16 works, they talk to each other. Today, AS 10 more or less in line with Ind AS 16. ICDS 5 is limited. It has a different methodology of accounting. Tangible fixed asset, anything which is tangible, which is land, building, machinery, plant, etc. Under this ICDS, assets for the purpose of rental administration are not explicitly covered, which because it becomes income from house property. Standby equipments and service equipments, majority of times, wherever I'm running a company, if I'm running it for 365 days, I need to have some backup machines. I should capitalize and I should start amortizing that. Machinery space. There is, if you read AS, between AS2 and AS10, there is a clarification. If my spares is something which I consume immediately, then it goes to AS2. If spares are something which is specific to an asset and it has a longer life, then it falls into AS10. Same thing is taken in ICDS 5 also. Cost of fixed assets, a very important thing whenever you do income tax audit or statutory audit. What are those items which falls into fixed asset? Interest, rent, par, depreciation, hundreds of things may come. In my next slide, I'll be explaining on those. All those costs, if you take it to P&L, there are chances that it will get disallowed under Income Tax Act. Before you conclude on that, see a complete end-to-end picture, whether the cost is by any chance linked with the asset. If it is linked with the asset, please capitalize it, else it may get disallowed. Borrowing cost, AS16 read with AS10, similar fashion in ICDS 5. If cost is incurred towards an asset, in AS, we have something called qualifying asset. In ICDS, all assets are qualifying assets, except inventory. For inventory, they have a definition of 12 months. Asset retirement obligations, it is there in Ind AS 16. What it tells is, if I am a tenant and I have taken building from a landlord, he will tell me per month you will be paying this much of rent and over a period of 4 years. After 4 years, it is your obligation to give me back my property in the way it looks today. For example, there is a shell which he has given. I would have gone and created an infrastructure. I would have created workspaces. I would have created cabins, etc. He tells whatever you have done is for your requirement. It for me, it is a negative thing. So when you go back, you should clean everything and hand over the keys to me the way I gave it to you. At that point in time, I will end up at the end of 4 years, I may end up paying a very big money for clearing all those infrastructure which I had created. As per AS10 and Ind AS 16, we identify how much is that amount which I need to pay at the end of the tenure. I will identify today and I will capitalize that. And it is called asset retirement obligation. The obligations which I need to bear when I retire the asset, that gets capitalized in accounting standard. But that is not an allowable expenditure at this moment in ICDS. So whatever I have capitalized in accounting standard, I will reduce that when I compute ICDS, and I will compute depreciation only on the actual amount I had paid to buy the lease or to buy the interiors, whatever I have done. So that difference will come. And in ICDS, I'll claim it when I actually spend the money. Then when I do all those rectification and I give it to him, I'll claim that as an expenditure. Financing costs, again, I explained, if I'm buying an asset and if I'm taking a credit period from the vendor, then as per Ind AS 16, I need to identify what is the portion of interest and I will debit interest to finance cost. Whereas in ICDS, there is no such concept. Whatever I am paying it to a vendor, whether I pay it today or over next 20 years, the entire amount, whatever I had decided, will become cost of my asset. It goes and hits my block of asset. Test run projects, test run costs. If the assessee is building a project and that plant to run, after running, it has to prove that it is producing as per the requirement of customers. and customers needs to approve that your product is up to the mark. So at that moment, whatever raw materials I consume, whatever power charges I have spent to convert my raw materials into finished goods, that cost I should add it to my fixed asset. It cannot go to COGS. It cannot become part of my P&L. That entire testing cost will become part of my fixed asset. And during that period, whatever I had produced, if I'm able to sell whatever I have sold, that value I will reduce it from my cost of asset. Example, if my cost of asset is say 80 crores and I've spent raw materials say around 35 lakh, my cost of asset is 80 crore plus 35 lakh. If that 35 lakh materials are sold at 10 lakh, then the 10 lakh I reduce. So 80 crore, 35 lakh minus 10 lakh, which is 80 crore, 25 lakh. That much I will capitalize in my books. Cost of project is again a very important topic. In all manufacturing companies, they take something called project finance. They go to banker, they explain my project is this, and this takes 12 months for me to set up the project, which requires constructing building, importing machineries, creating an infrastructure, and putting it to use. This entire project finance will come as one single loan for the whole project. And during that process, I may purchase land, which is not a qualifying asset. I may construct building, which can be a qualifying asset. I may buy a plant, which can either be a qualifying asset or not a qualifying asset. I will spend employees' time on that, which actually it is not an asset, but it is an expenditure. I may spend money on security. I may spend money on rent for that place because I need to, it's something which I've taken from third party. I may spend money on various other expenses, regulatory expenses. All these expenses will fall under a bracket called project cost, and I will capitalize those. And during that process, I have also borrowed funds, and that whatever funds I have borrowed is used for the whole project as such. Even that I will capitalize, and I'll show it as project as a project cost. And once it is put to use, ready for its use, I'll allocate what are the main projects in the project, what are the main things: land, building, plant. And this expense I allocate on these only to land. I cannot allocate because it is not a qualifying asset. Between building and plant, I may allocate all this expense based on proper module. It could be either on the total money spent or the time spent, etc. Cost of improvements and repairs. Generally, repairs are charged to P&L, not capitalized. Improvements may be capitalized if that improvements gives a better health and life for the asset. If that improvement is just to maintain the asset, it will go to P&L. Cost of an additional extension to an existing fixed asset. Again, we need to answer the thumb rule. Is it giving me an additional life or additional facility? Then you capitalize. Otherwise, take it into P&L. Where certain assets are purchased for a consolidated price, the consideration shall be apportioned to the various assets. Again, this is generally in a slump sale. I buy a running business, an undertaking as such. When I buy an undertaking as such, there is no GST on that. That is the whole reason why people do slump sale. There, I don't pick, I don't do a, there is something called cherry picking. Cherry picking means I go find, identify, okay, I need this asset. I don't want that liability. I don't want this employee, etc. That is called cherry picking. That I don't do. I do a slump sale. At that time, whatever is there in that segment comes to me as a going concern, business as a going concern. And I will not even be, I would have done my due diligence, but still I may not know what and all is included over there. I might not have assigned value to each line item of asset or a liability. I would have said on a bulk, I'm going to pay you 60 crores for taking over this business. When the business comes, it comes with lot of assets, lot of liabilities. How should I identify the cost? The way it is done is I will get one valuation done. I identify the value for each component of the business undertaking. Then I will allocate the price which I paid on a weighted average basis on all these assets and liabilities. Depreciation, you all know, I don't think so. I will have to explain anything on this. Cost of leases for assets used in construction, just now I explained. When you do project capitalization, you will add cost of lease. Manufacturing plant, cost for regulatory approval. Imagine you are starting a new plant in a rural area. You may be asked to spend, to pay certain duties for the kind of facilities you are going to create or the kind of negative things which you are doing there. It's a forest area, you are cutting certain trees and plants. They will seek certain approvals and you will have to make payments for those. Can I claim that as a cost of my asset? Again, the answer here is this is subject to confirmation from the regulator. If I'm sure that I will get his approval, I will capitalize. If at the point of time I am paying, if I'm not sure that I'm gonna get the approval, I debit to P&L. The question comes under Income Tax Act, is it an allowable expenditure? There are a couple of case laws which says this is a capital payment, capital expenditure, and that may get disallowed. There are few case laws which says it is in the course of the business and you can claim. So you need to read both the case laws, understand your business, and then take a proper stand. That is different. You are talking about the lease regulatory fees. That only when I know that I get the asset. Imagine I paid it, but I didn't get the asset, that I didn't get the approval. Then it is an expenditure. In accounting standards, we have something called materiality, which is not there in ICDS. In accounting standard, if an asset is below materiality level, I may depreciate 100%. Example, if it is less than 5,000, I may depreciate 100%. Under ICDS, sorry, nothing. Even 1 rupee, you should capitalize. You should add it to block of asset, claim depreciation. Replacement costs and subsequent costs. If I have to replace an asset, a component, that component under accounting standard, I reduce from the existing asset and add a new component. In ICDS, if I get something for the asset, component which I'm replacing, show it as reduction from my block, and whatever cost I'm going to incur, add as additions in the block. Relocation costs, I'm moving my plant from one facility to the other facility. Under accounting standard, that is not part of asset because it is not adding any value to the asset. I'll have to debit it to P&L. LD receipt, liquidated damages. I had given project to one vendor. He did not complete within the time period. He pays me liquidated damages. This liquidated damage, even though connected with my asset, this is not related to asset. It was not required to be received for the asset. So I will take it into P&L and I will tax it as an income. Inauguration costs, all the costs which they incur for opening facilities, not to be capitalized, it goes to P&L. Again, the one more issue may come from the income tax side. Your plant was not ready to use, so you incur some expenditure. It may become pre-operating cost. Again, it has to be properly documented. Yeah. Yes. Insurance claim on fixed assets, I will account only when I receive the money, and once I receive, it will go to my income. Last part in this, disclosures. We need to disclose. Here, disclosure is very simple. Whatever is there in clause 18 of 3CD, that comes, which is basically what is my opening WDV, what are all the additions, what is the consideration I receive and what is my closing WDV. Of course, on the Senvat credit or whatever by name we call, that gets adjusted here. If I have received any subsidy or grant or reimbursement, I will have to reduce to that extent from my block of asset. There will be one more column which talks about the depreciation which is allowable. Depreciation is computed as per section 32. Whether put to use for 182 days or no, that will again come, and those are all same. So maybe here I completed 5. Should we take a break?
I lost. We have put there. And music, then feel very.
We'll take no?
He is coming. We can take a shot. 6 to also you. Number 7, 8, 9, 10 after teach. He's on the way.
Who is on the way?
He is on the way.
He is on the way.
Making it transit. Export revenue expenses, any concept?
In accounting standard, there is nothing called deferred revenue expense. In income tax, unless you incur, you will not get. So that was the.
Expenses or something which is huge.
Just because it is huge, you can't claim. You should substantiate how is it related to your asset.
Instead of getting in one P&L, spread it to 3 years, 5 years like that.
Under accounting standard, it's not allowed. There is no deferred revenue expenditure.
We debit loss like result.
You need to see whether it is giving you any intangible asset. Is it giving you a kind of, again, under intangible asset is very difficult under Ind AS 36 and 38 to substantiate. It actually gives me benefit. So there, to give actually an example, this is very small. Should see pharma industry. In pharma industry, if at all you are what do you call coming up with a new product, even though if it is generic product, you'll have to spend so much of money first to make the product. Then you need to test it on different. You will do on animals. The final last one is human being. It will go till human being until they would have spent 98, 99%. Only after that, the authorities will approve. And only after approval, you can capitalize. So what is there is that? Nothing. You have spent 99%, what 1% is left. So you can't capitalize anything. And it will go to an extent until that fellow, there, if everything is fine, last one small leg, you fail. You have to restart from 1. So whatever you have spent is a loss. That is how intangible works.
Foreign collaborators. They came and we had a meeting with the existing customers for a new something different product. For that, they spent so much.
Just marketing.
Like book marketing.
That's marketing or research. Either of those two. Under AS 26 or Ind AS, research cost cannot be capitalized. There should be a confirmation that I am able to make a product out of it and product is saleable. See, all these things, whatever the software companies, startups which do now, they will say it is idea. It's a thought process. But you cannot substantiate this thought process will get converted into cash. So they can't capitalize. That's how the whole thing works. Effects of changes in foreign exchange rates. ICDS 6, which is nothing but our accounting standard 11. How should I account and claim the expenditure or the asset or the liability which is fluctuating because of foreign exchange movement. When I'm doing a transaction with the entity which is not in India, and my transaction, my financial instrument is not an INR, it is a comparable currency, comparable exchange, which can be United States dollars or euro or pound. At that point in time, we need to know how the accounting will happen. AS11 will explain that. ICDS 6 will explain how should we claim it in the books of account. This income standard deals with treatment of transactions in foreign currencies, translating the financial statements of foreign operations, treatment of foreign currency transactions in the nature of forward exchange contracts. Few of the concepts which we should know when we are doing foreign exchange transaction: TT buying rate and TT selling rate. Majority of the times when I visit or when I talk to people, they say, for me to compute foreign exchange conversion, I go to RBI website, I check archives, from there I take the value and I convert. Please note that is not the rate which you can consider. RBI provides guidelines to other bankers as to what could be their delta when they compute. So what exactly happens there is, I need to go and buy foreign currency from someone and I will sell it to someone. When I do that, obviously, if I'm a dealer, I want to make money. I buy at one rate and I sell with a profit. So if I am a company and if I need to go to a dealer, if I go to him with euro, he will buy it at a price which is less than the same euro if he wants to sell it to me. So there is always a delta. And that delta needs to be properly accounted. TT buying and DT selling gives you that. TT selling is the rate at which banks sells it to the customer. TT buying is the rate at which banks buys from the customer. So bank has to buy means I need to sell it to bank. If I need to sell it to bank, I should be having foreign currency. So I should be an exporter. If bank has to sell it to me, means I need to purchase it from him, means I have an obligation, which is nothing but I'm a creditor. If I'm a creditor, my TT rate will be higher than I as a debtor. And if you see today, if you go and check, your RBI rate may say 82.5 rupees, but if you check with your banker, assuming you are working with Kotak Mahindra, he will say mine is 84 rupees. The reason being he has his margin and he has adjusted it as of now. If you understand how the rate changes, it changes at nanosecond. Every nanosecond, the price fluctuates. And what you see from bank is 1 day ka average. There are companies, consultants who actually give you one of the best rates. If you see all big companies, there they book, they use the word called I book my forward contract. I book my liabilities, etc. So there they analyze at what rate I'll get my currency and at what rate I'll book it. So again, that comes under forward contracts that I'll explain. If not, I'm taking forward contract, there is a possibility that, if I go to these kind of service providers, they may give me a better rate. Between two bankers, there can be different rates. ICICI Bank at the same rate may be doing a transaction which is different from what Kotak Mahindra may be doing. There may be negotiation which is required. There are people who does negotiation and they'll give you better rate. Trade receivable, I explained. Section 43A speaks about if I have bought an asset from a vendor who is outside India and that fellow has given me a credit, which means I have purchased an asset against a non-resident loan. And that non-resident loan is generally in a currency which is other than INR. So I would have purchased an asset today, and he has told me you pay me after 6 months over three installments. Today I have purchased when it was 82 bucks. After 2 months, it becomes 83 rupees. Then it may become 84 rupees. So this fluctuation, as per 43A, I should hit to my fixed assets. So there is a specific column in clause 8 which requires me to update the foreign exchange fluctuation which is involved in this. Small difference in this, generally people get confused. I can also import equipment against a loan, but that loan may be taken in from local lender. In that scenario, this adjustment will not come. Means to say, I had to buy a machine from Italy. For that, I go to my local banker. My local banker will give me a letter of credit. That letter of credit, I give it to my vendor. That vendor gives it to his banker. He confirms as the letter of credit is fine. Then the movement will happen. And once the machine comes to my location, this documentation, I will hand it over to my shipper. My shipper will in turn give it to the seller's banker. That's where the transaction gets closed. So I got my equipment against a letter of credit, and the letter of credit is given by my local SBI bank. In this case, borrowing is in INR. I don't have to do any foreign fluctuation adjustment. This needs to be, you have to be careful on that.
There's great something and.
Supplier's credit means,
Supply.
yes, yes. There'll be packing credit is one of the supplier's credit. So in packing credit, these are all different, facilities which are available. Supplier's credit will generally be in foreign currency. There I will have to do adjustment. So what happens in supplier's credit? I go to ICICI Bank. I will say, look, I have a export invoice. Against that, I need some imports which I need to do. You help me in giving me the supplier credit. So he will give me a loan which is way cheaper compared with the local currency loan. He may give me a 3% or 3.5% interest. But I need foreign currency. So then what happens? It is just 3.5%. Whereas if I go to old, it is 8.5%. 5% is my margin. But you have to be careful while booking the forward contract. If you make an error in booking forward contract, the foreign fluctuation will be more than 5%. So this needs to be properly checked. Forward exchange contract, I'll spend some time on explaining this. What exactly a forward exchange contract is? Imagine I am a exporter and I have sold my product and I need to get 1 million euros. They say I will give you 1 million euros after 3 months. I have a doubt. Some things are happening with Ukraine and Russia. Some changes may happen. Because of this, the currency fluctuation could happen. So what I will do, I would like to ensure that I'm not gonna lose any money. I have 1 million euro receivable. I have a invoice with me, which has been accepted by my customer. I go to my banker and I will say, look, I have $1 million receivable. Please give me a forward contract. In that, I'll say today rate euro is 94 rupees and there is a chance that 94 will reduce. So the banker says, what I will sell it, I will give this forward contract, let's say 93.5 rupees with a premium of some amount. And I buy that. The forward today, the exchange rate is 93. I buy it at 93.5. So what I have done, when I receive $1 million, 1 million euro, I can convert 1 million euro at 93.5 rupees. So it is insured, whatever it is, I will get 93.5 rupees. So that 50 paisa, what I am paying more today to buy a forward contract is called forward premium. And that forward premium is for next 3 months. That how many ever euros I am buying into 0.5 rupees, I will allocate it over next 3 months. That is what forward contract premium accounting is. And under ICDS, I will claim it over next 3 months and not at one shot when I actually make the payment. On the other hand, if I am a future or a forward player, then I'll be able to claim only when I incur such expenditure. So there is a difference on that. Certain practical cases, how to compute forex losses, which is pretty simple. At the time of transaction, what was the rate versus at the time of settlement, what is the rate? Difference of those two will come to P&L. Such ready, na?
Rather than you.
Sure. Here, certain challenges will happen in ERPs. Whoever is using ERPs, you will notice in an ERP, they will put some rate at a global level. For this particular month, exchange rate is 83.5. They would have fed into the system. So any transaction, it will account to 83.5 rupees. But when you go as an auditor, you will have to check what is the exact rate and you need to pass a differential AJV, audit journal voucher you will pass if it is material, and that could be a big exercise. And generally, for our team, this work will be little higher when we work for manufacturing companies, which is working on an SAP or an Oracle or a similar one. So we track each transaction, put the rates and apply the difference. Sometimes what we do, if the transactions are too much, AS11 or ICDS both gives me an option. Instead of going for individual transaction, I can take average rate of the month. The average rate of month, if it is not varying, fluctuating too much, average rate is allowed. And generally what people do, simple way to get average rate is go to the customs CPIC notification. There will be exchange rate. That exchange rate apply to your transaction, close it. Why it is easy is you will pay customs duty as per that notification and your accounts will also maintain as per that notification. There won't be any difference. If there is multiple changes in the rate, on the first week exchange was 82, by second week it becomes 80, by third week it becomes 84. If it is fluctuating too much, then you cannot use monthly average. You should go by actual transaction rate. Advance for services, I explained. Monthly rates, I explained. Impact of Forex in analytics, which is very important. When you do gross profit analysis, if exchange rates is impacting your revenue, if you see the results which people give, very simple example, Infosys. When Infosys gives results, it will tell my profit is increased by so much percentage. Out of that, X percentage is because of depreciation in INR. Because INR depreciated, I got a better profit. And as a stakeholder, it's for me to decide whether this is a good thing or a bad thing. Generally, people say if it is not within my control. A profit today may become a loss tomorrow. So it's a risk factor. Forex loss and its impact on transfer pricing. Forex, whenever there is a Forex loss under transfer pricing, it has to be considered as an operating cost. On such cost, you have to compute your margin. You cannot exclude Forex loss and if it is Forex gain, you will take it as a reduction from the expenditure and only on the net amount, you will charge your margin for the related parties. Forex loss and its impact on FA, just now I explained, it will be adjusted as per section 43A. EFC accounting, again, another good thing. EFC, exchange earners foreign currency account. If I'm transacting too much on foreign currency, I can go and open an EFC account with the banker where I am allowed to keep foreign currency as such. I will not convert foreign currency into INR and it becomes a natural hedge. I have a foreign currency receivable. I have a foreign currency payable. It comes into my EFC account. From EFC account, I make the payment. So it's a natural hedge. I got 100 euros. I paid 100 euros, no impact on foreign exchange fluctuation. But when you close your books, that EFC account, you should convert it into INR using the exchange rate. Then you will have foreign currency fluctuation. Plus, as per RBI guidelines, you cannot keep money for long in EFC account. It fluctuates. It may be maximum, it allows 2 months or 3 months to keep it there. After that, automatically they only convert it into INR. And again, then you will have a conversion rate. Packing rate, I explained. Foreign currency translation reserve, this used to be part of our accounting standard. Rather, even now, it is part of accounting standard. It comes when I consolidate my foreign operation. Imagine a scenario. I have invested in my subsidiary or my branch on, say, building or land. When I purchased when the dollar was 60 rupees. Today, dollar has become 82 rupees. By doing nothing, just because there is a depreciation in INR, my value of property has increased by 22 rupees. And this is called foreign currency translation. I translated the amount into a different rate. But if this asset is non-monetary in nature, I will still continue at 56 rupees itself. I will not make the difference. So these are all the adjustments which we do when we do the consolidation, and we keep it as a separate working note. Non-monetary, I have not restated, and that's why there is a difference. Monetary, I have restated, that's why there is a difference. Those things we need to document in our work papers. Forward contracts, I explained. Did I miss anything in this?
Here in the EEFC. CNRB we can keep in foreign currency, personal accounts, foreign currency, non-resident.
Okay. EFC is for corporates. Resident corporate, resident individual. For your foreign currency, what you said is ordinary and non-resident something, master account and master account. Those are, you need to be a resident, non-resident or income earned when you are outside India. Those kind of criteria is there. So, yes, sir. So I'm done. Huh?
You can comments are
Yes, sir. Yeah, sure.
members tea break for 10-15 minutes. Chairman is there, but we are given me the privilege. That's what in charge. More than so, almost check. 4 seconds. Okay. Right.
అసలు చెప్తుండేవాడు నేను అవును సార్ చెప్తుంటాడు
ఇది పాస్ అంట పాస్ పెట్టాలి కదా
Recording in progress.
మళ్ళీ
So government grants, basically there is a standard, accounting standard, which speaks about the government grants. Any amount which is received from government, either as a capital contribution or a revenue contribution, either as promoter, in the nature of promoters or in the nature of vendors, That accounting is given in accounting standard. How should the same be treated under ICDS? That is the requirement this accounting company disclosure standard talks about. If grant is directly related to acquisition of a depreciable asset, as per our clause 18, the amount whatever is collected will be reduced from the block of asset. If grant is not directly related to acquisition of depreciable asset, then the proportion grant shall be reduced from the cost order. Generally, this thing doesn't happen. It's more of a theoretical thing. So I'm not spending much time on that. If grant is directly related to acquisition of a non-depreciable asset, then you have to recognize as an income over the same period over which cost of meeting such obligation is charged to income. I would have been spending some money for the period for which I spent. I will identify the grant which is being received and allocate over the period. Grants receivable as compensation for expenses or loss, adjust it over the period when the expenses are incurred. Other government grants recognized as an income over the period necessary to match them with the cost. On an accrual basis, you just accrue it. If grant is when grant was given, initially with the condition grant was given, and subsequently those conditions aren't met, then the grant becomes refundable. Such scenarios, what has to be done? If the grant was related to a depreciable asset, initially when the grant was given, you would have reduced it from the WDV. Now you go back and add it to the WDV, and the revised WDV, the updated WDV will be allocated over the balance life. Your depreciation will be claimed over the balance period of life. Otherwise, wherever there was unamortized deferred credit, if the credit is remaining, go and adjust it there, and the amount is more, charge it to P&L. It will be allowed in the period when you charge it to P&L. Assume the deferred value was only 100 and you had to refund 200. There is additional 100 which goes to the P&L. Disclosure wise, you have to disclose the grants which you have recognized during the year by of deduction from the actual cost, which is basically the depreciable asset. Nature and extent of government grants recognized during the previous year as income, which is against your activities. Nature and extent of government grants not recognized during the year by of deduction from the actual cost. Nature and extent of government grants not recognized during the year as income, in the sense where I am not recognizing something as an income. I need to explain what is the reason for that, and that has to be with the proper documentation. So now securities, I'll not, again in securities, I'll not be spending so long on this. In summary, what happens, this is applicable when the assessee is a, for assessee, the security is a inventory. He is a trader or he is a dealer, and who is on a regular basis using his business through for his business, he is using or is transacting with the securities. Securities can be of various stuff, the stocks, the debentures, and etc. These are all called different products per se. We need to understand those basic things. At the initial recognition time, I will consider the total money which is spent for acquiring the particular stock or an instrument. And for that, we'll have to add brokerage, the taxes, duties, and cess. That will go into our inventory of stock. Where a security is acquired in exchange for other securities, then the actual cost will be the fair value of that security which is acquired. In case of interest bearing securities, the way interest bearing all these debt securities works, there is an interest which is accrued, but it will be paid subsequently. If that interest comes to me subsequently after acquiring, I will reduce the interest from the cost of acquisition. In general, the stocks are accounted on a first in, first out basis, and unlisted stocks are accounted on actual cost basis. These stocks movements are accounted through NRV. If at all there is a change in the NRV, like how we read in ICDS2, the cost or NRV is applicable here also. But the difference is it will not be done on line item wise. Instead, it will be done on a category wise. Share may be one category, debt may be another category. I have given two tables over here. In share category, the cost was total 560, which includes various line items. Against that, the NRV was 535. And in this case, the NRV is reduced by X amount, and that will be debited to the P&L. So what has happened, just to give an example how this had an impact on P&L, during COVID, in the first COVID wave, the market started to react after March 24th. Imagine a scenario where you had invested, you are a dealer on that and you had purchased, the price was high, and by March 15th, you might have made an advance tax payment. By March 26th, the entire market was down, which resulted in a big hit on the cost, on the NRV. That difference, people would have taken it into P&L, and because of this ICDS 8, it was allowed as a deduction. Whatever advance tax you would have paid, a major portion would have come as a refund. Then the biggest impact was not this, the subsequent one. This market started to recover from Q2, Q3, and Q4. By Q2 and Q3, it was recovering a good extent. And in the month of September, when you had to pay advance tax, whatever losses you had booked was back into action. And in that period, it was coming up. So the reverse happens, scenario is payable. If you see from the tax audit side, your tax audit is not yet completed. There is a refund scenario. And by Q2, there is a payment scenario. And generally during COVID, majority of our IFRS gave exceptions, but unfortunately we didn't have any exemptions over here. These kind of fluctuations affect the assessing. That decide or rather planning is very much challenging, but you need to see how this can be accounted in the books, and these fluctuations should be properly recorded. There were quite a few notices which we have seen around this, but and again the second thing was with all these AS and TS being coming, the transactions are being properly recorded, and also identifying this loss is not a very difficult thing. All these fund managers, they give account statement and they give statement on category wise. So for you to compute cost and NRV is not a big challenge. It can be easily identified and it can be appropriately accounted. Comparison between AS13 and CDS8. AS13 was with securities held as investments, whereas ICDS is only on the stock in trade. AS13 does not talk about unlisted shares, whereas ICDS speaks about unlisted shares. So borrowing cost, I have borrowing cost, and the next one will be the provisions. I spent some time on borrowing cost. As our accounting standard speaks, borrowing cost is the cost incurred for acquiring an asset, and as per accounting standard, the asset should be a qualifying asset. Means to say, an asset takes substantially a longer period of time to get into operations, and that is considered as 12 months. Whereas when we talk about ICDS, the qualifying asset definition is little different. All assets are considered to be qualifying. Only the inventory, they say, if it takes more than 12 months, then it becomes qualifying. So there is a small change in that. When you do your books, you should be aware of this. If something is not capitalized in books, there may be a scenario you will have to consider for ICDS purpose. What kind of cost may come? It may be bill discounting, it may be interest on loan, it may be also the impact of foreign exchange fluctuation to the extent of borrowing cost. Commitment charges, again, that's a part of finance cost. Amortization of discounts or premium related to borrowings. I was explaining you forward contract, the forward premium, that is again a borrowing cost. Amortized amount of ancillary costs incurred in connection with the arrangement of borrowing. The FAQ over here could be whether bill discounting charges and other similar charges would fall under the definition of borrowing cost. Bill discounting, basically the concept of bill discounting is I have a revenue invoice and there is a credit period from the customer. I use that revenue invoice, go to a banker and banker discounts it. For he doing a discounting, he will charge some money. Per se, that is a finance cost. And where do you use that fund depends on you to analyze whether that has to be debited to P&L or taken into the asset. Qualifying asset, just now I explained. Only in inventory there is a 12-month criteria. Otherwise, straightforward for the assets, intangible assets, we have to consider it. Small change in ICDS compared with AS. When a borrowing is specific purpose borrowing, the interest will get capitalized directly to the asset. If it is a general purpose borrowing and multiple assets are taken, we need to understand, we need to identify two set of items. Those assets which are purchased against specific borrowings, those assets which are purchased against general borrowings, and the general assets which are not even part of the borrowings. And the interest what you are paying on working capital, if it is for general purpose, that interest needs to be capitalized into the asset. And the formula which ICDS refers is A into B divided by C. A being the interest, B is that average cost of qualifying assets, which is appearing in the balance sheet. And C is the average amount of total assets, my total of the balance sheet, less qualifying assets, which are already identified. So that much of our ratio will go into my qualifying assets. For the limited purpose of computation of this capitalization, qualifying assets here in A into B by C, we take 12 months criteria. In the previous slide, for a qualifying asset, I explained it there is no 12 months. Only for this purpose of A into B by C, they have given this 12 months criteria. This specific borrowing cost, the commencement date will be date of borrowing and cessation will be the day asset is put to use. The interest should be stopped, similar to Accounting Standard 16. Difference between ICDS and AS, income earned on temporary investment. Under AS 16, we adjust it from the borrowing cost, whereas in ICDS, there is no such adjustment. Suspense of capitalization. In AS 16, there is a concept of suspending the capitalization for the period where asset, rather activity is not happening. Such concept is not there in ICDS. Disclosures, the accounting policy adopted by the entity has to be disclosed, and amount of costs which are capitalized during the year needs to be disclosed. Provisions, contingent liabilities and assets. Provisions are basically liability which can be measured only by using a, basically there is an estimation involved. I know I have incurred an activity, but the expenditure is not clear. There is an estimation which is involved. Example, gratuity, leave encashment, warranty, bad debts, various stuff which will come over there. Whereas liability is something where I have incurred, I know what I have incurred and I know what is the value also. General liabilities are those which comes up with the purchase order. Audit fees is a liability, even though it is not. Many times I see people updating audit fees under provision for expenses, which is a mistake. It has to come under liability because I know before I start, I would have signed an engagement letter and I know what is the value which is involved over there. Contingent liability is a possible obligation that arise from past events and existence of which will be confirmed only by the occurrence or non-occurrence of a certain activity. Means there was a litigation. Whether the litigation will convert into liability or not depends on the happenings. This only gets disclosed. Similar fashion asset on the asset side. Few expenditures which are actually provisions and not difference, rather whether it's a provision or a liability. Amount payable for utilities like electricity, gas, etc. It is not provision, it's a liability. Only thing is, as on 31st March, I may not had paid, but I know what is the value. So it's a liability. Keeping in mind, if any amount is shown as provision, there is a requirement to disallow under income tax. Whereas if it is liability, it need not to be disallowed. Amount payable for goods received but invoice not received, again a liability, not a provision. Warranty obligation is a provision. Accrued interest payable is a liability. I know what is the interest rate. I know what is the loan outstanding. Unearned revenue, again liability, because I know how much revenue I have earned and how much money I have received. The difference is unearned. Should the provision be reviewed at the end of each accounting year? Yes, it is a continuous process, each reporting period rather. Should provision be recognized for cash refunds, which is a sales return? Yes, I have to make an assumption based on my past records, how many cases my sales may get returned. I create a provision and that will be allowed only on actual basis. Will the accounting for recurrence provision undergo a change once the amount payable under the obligation becomes certain? Of course, the moment that activity becomes certain, from the heading provision, it becomes liability. What's an onerous contract? Onerous contract is a scenario where I have entered into a contract with my customer. For that, the cost which I am going to incur is more than the revenue which I am going to earn. That is an onerous contract. Generally, when the times how it happens is, I have entered for a contract. Again, it happened many times during COVID, rather post-COVID also. Majority of the people who use chips, which is basically a technology-based and mineral-based one, the supply has reduced a lot. These chips are used in mobile phones, for car and etc. Majority of the cases, car delivery is being delayed because of non-availability of these chips. And the prices has increased almost from 50 euros to 450 euros. Imagine a scenario where you are working with a customer and it's a fixed price contract. You have no option to cancel the contract and the prices have moved from 50 euros to 450 euros. It is for sure that you are going to incur a loss and you accrue that losses immediately. That under AS, whereas under ICDS, you cannot claim that as a reduction unless it actually happens. Disclosure side, a brief description on the nature of obligation needs to be disclosed. Carrying amount of the provisions at the start of the year, at the end of the year needs to be disclosed. Additional provisions made during the, it's a long table which comes. Additional provisions made gets updated. Amounts utilized and reduced gets disclosed in the notes. Unused amounts which is reversed also gets disclosed in the notes. The way it has to be taken up in computation is from opening balance. Generally, opening balance is always disallowed. That is a temporary difference. Current year addition gets disallowed in the current year. Current year reversals will not be taxed in the current year because it was not claimed as deduction in the earlier years. If it is reversed now, it should not be taxed. Whatever is actually paid will be allowed as a deduction. And closing balance is again a temporary difference which will get, which is a accumulated balances of amounts which are disallowed. So with this, I'm closing the session. The dash is open for questions. If there are any questions, I'll be more than happy to take.
Yeah.
As per the income tax act, we have to disclose.
No need. No need. See, what happens is, as per AS1 or ICDS1, you will have to explain what is your accounting policy for depreciation. That you will disclose. Then, as per ICDS, you will also mention what are the components of your WDV and depreciation. That also gets disclosed, both in disclosure and the accounting standard. Notes on account. Yes, and also it comes in 3 CD. Your accounting policy you need to disclose. So in that you will say my depreciation rates as per schedule 1 to the device schedule 1 to the income tax rules. That is enough. Yes. Generally, everyone follows exclusive method, but for this purposes, you have to compute. Had you considered it on inclusive method, is there any difference in the profit? There is a guidance note on 145A which tells you how should you consider it on opening stock, how should you consider on purchases. On the value addition, there won't be any losses. No need to disclose. You will have to disclose if there is any impact. Otherwise, no need. It's like how we talk about accounting standard general assumptions. This is also an assumption that tax impact is zero. No need. No need. You will answer in 3CD. No, you will say 45. No, that itself you will show. Yes. Yes.
Feedback from the department on the compliance of ICDS.
Feedback in the sense, sir, there were certain negative comments in 3CD, which I was explaining in the first half. No, it's okay. So what happens, the way it gets disclosed, for example, because of foreign exchange fluctuation, some wrong entries they would have shown in 3CD, and that is not updated in IT returns. The whole thing is in 3CD you have given some adjustments, but in ITR you have not done that. Only because of that you will get comments. Otherwise, generally no. And the only impacts which generally comes is provision anyway. If you are a corporate entity, you would have disallowed. Only non-corporate, it may be a different thing. ICDS on the depreciation, whether this ICDS was there or not, you would have been following section 32. You would have disallowed your regular thing and you would have claimed your section 32. Inventories, unless if there is a long gestation period inventory and it is out of borrowed funds and interest is not considered in inventory, they may disallow that. Otherwise, generally, no. It's more on the notes. That I had explained, no, it will be if it is depreciable, you reduce from your block of asset. For asset, see, there are two things. There is no definition of capital grant unless if it is for the trust purpose. If it is other than trust, the grant can be either in the nature of promoter contribution. No, sir, here. No, in which league is it, in trust or other than trust? Hmm. Why corporate society has got capital grant? No, why they are getting capital grants? No, for what purposes should it be used? For what purposes should it be used? So that is where it comes. See, sir, it is very simple in ICDS, sir. If it is for depreciable asset, you go and, huh? I gave no. That's it.
Yes,
Okay.
sir.
Thanks.
Recording, please. After
Thank you, sir, for the explanation, very patient.